Hi, everyone. This is Eric Johnson. I am delighted to be back with you for what is our second episode of Logtech Live. I am joining you here from my normal home in Washington, D.C. area. Last month, I was in India for our inaugural episode. Any of you who know me know I like to bounce around, so you never know where you might find me, but most of the time it's going to be here in beautiful Alexandria, Virginia. Thank you all for joining today. We have a great show lined up for you. Joining me later today is going to be Joanne Lynn, principal at Newark Venture Partners. But before that, I'm going to run through some news headlines of the week, and we'll wrap up as normal with some dad jokes and a buzzword in the tech industry that you all need to know about, and I'll give my judgment on whether it's actually meaningful or not. Before we get going, I want to say thanks, as always, to our sponsor, Chain.io. Really appreciate your support. And also, please get your questions, get your comments in. This is meant to be a fun, interactive 45 minutes, so please don't hesitate. I will try to address as many of those as we possibly can, but we have a lot of stuff to talk about. It's a crazy time in the logistics industry right now, tech or otherwise. So let me, before I bring in Joanne, let me run through a few kind of things that caught my eye, especially over the last week. Congestion. This is probably the biggest topic in the logistics industry right now, right? So we at JOC, which is my job when I'm not hosting Logtech Live, we're writing about this all the time. And obviously, a lot of different outlets are covering the extent of the congestion in the logistics industry right now. There's also, we're seeing a lot of sort of who is to blame kind of discussions that are going around, right? Who's ultimately responsible for the situation right now? I think the short answer is there's not one entity, right? Or there's not one person or to point the finger at, right? So there's a lot of different things that are happening right now, including us in terms of buying a lot of stuff in North America, right? So I wanted to point this particular story out that my colleague Bill Mongaluzzo did just this past week, just a couple days ago, because I think it's really instructive. This talks about the fact that the container lines, who have been announcing sky high profits most of 2021, are injecting a lot of capacity into the Trans-Pacific trade. They're actually going to be injecting, I think, somewhere in the neighborhood of 20% extra capacity in September through the end of the year over what they were offering from March to July. That's great. That should solve some of the problems. Well, the problem is there's not a lot of port capacity to handle all of that excess service that's being added, extra vessels that are being added, right? So one solution that seems to solve a lot of problems isn't necessarily the solution that it might be, because there's other constraints on the system. So congestion is definitely a multifaceted issue with a lot of different dynamics. It's not easy to drill it down to one sort of culprit, as it were. So moving on, and I sort of alluded to this, there's a lot of, acrimony toward container lines. And, to a certain extent, I understand shipper and forwarder frustration with the current scenario. It's not easy to be dealing with your transportation budgets being blown apart and service kind of suffering significantly. And then seeing headlines in the JOC and elsewhere that shipping lines are making historic profits, literally, wiping away 10 years of losses in a couple quarters. But I thought this piece from almost a month ago now. This actually came out just after our last show, and that's why I wanted to bring it up. I thought this was really instructive. If you look at the carrier financial reports, you'll see that the publicly traded container lines are actually reporting their average per TEU revenue. And that's really instructive, right? Because we're seeing a lot of talk in social media and elsewhere around, really astronomical freight rates, right? If you're a shipper and you need to find a rate for a box in the next 2 days, you're probably going to be quoted some ridiculously high figure in the neighborhood of 20 to even 30,000 I've seen, which is obviously 10, 15 times what you would have normally paid in, say 18 months ago, 2 years ago, right? So I put this up because a contributor to JOC, Lars Jensen, noted, well, carriers aren't getting all of that revenue. They're reporting somewhere around 15 to 1700, depending on the carrier, per TEU. So you double that for an FEU, a 40-foot container, you're looking at 3,500 per FEU. That doesn't correspond with $20,000 container rates. So we have to look at this as the cargo owners are paying a lot to get last minute need space filled, but all of that revenue is not going to one party, right? So just wanted to point that out to sort of get your mind around that this is, again, a multifaceted situation. So let's move on and get back to what I'm supposed to be talking about. I'm not supposed to be talking about port congestion. I'm supposed to be talking about technology. I wanted to point out a story that Emma Cosgrove at Business Insider, who's great. You all should be following her stuff if you're not already. I presume you are. She had a story a couple weeks ago that I think is really instructive around kind of the frothy Logtech market right now. Project 44, fresh off a couple acquisitions earlier this year, rumored to be IPOing, and also having raised about 300 million in the first, between December and say April. They have sort of signaled very clearly publicly to Emma that they're going on an acquisition spree. So they're not the only one. We've seen a lot of acquisitions, a lot of M&A activity in our space. Ida Open just yesterday formalized their acquisition of Blue Jay Solutions, massive acquisition, $1.7 billion acquisition. So I expect to see more of this. The industry shakes out in normal scenarios, but with all of the capital that's kind of flooded into the industry, and Joanne and I are going to talk about that in a second, it just creates a lot more opportunities for these kind of plays, right? You don't necessarily have to use your venture money only on engineers and salespeople. You can also, grow really quickly through acquisition in later stage rounds as well. And so finally, let me highlight my most recent Logtech letter, which is my weekly Substack column. I touched on David Lee Roth and who I think is sort of the quintessential rock front man or woman, and I sort of posed the question: have we seen? Bret Michaels is not the best, by the way. Just had to throw him in at the end. I sort of wanted to explore, like, has Logtech seen its David Lee Roth yet? And what does that look like, right? So it's very open-ended right now. So I'm certainly curious as well, and would love to hear kind of what your favorite lead singer is. Who do you sort of emulate when you're singing to yourself in the shower, I guess is probably one way to think about it. I certainly don't have the acrobatic capability that David Lee Roth has. But really the point of the article was, do we need sort of this charismatic person who captures the attention of not just our own industry, but even people outside of our industry, right? In the way that like a Jeff Bezos has for online commerce. And one of the other sort of things I looked at is Mark Benioff at Salesforce kind of a good maybe benchmark for someone in the logistics industry? Like, no one in kind of the real world cared about customer relationship management, but now Salesforce is a pretty known entity, and Mark Benioff is pretty famous at least within enterprise software circles. So are we going to see someone of that stature in Logtech? It would be interesting. I think we may, but who knows? All the forces kind of have to align. So that's probably a lead-in to my guest today. I'm really delighted to be joined by Joanne Lynn, a principal at Newark Venture Partners. Joanne, thank you so much for joining us.
Hey, Eric. Thank you so much for having me. And I'm really honored to be among the first few guests in the show. So this is really exciting.
Well, we've talked pretty regularly this year, so it felt like a natural thing to kind of bring our discussions into the public. So, why don't
Yeah,
you
that's great.
start off by just sort of giving everyone a little background on yourself and how you got into VC?
Totally. And before I do that, I just want to make a quick note about that last Logtech letter that she wrote, because I think there's, you and I have talked about interesting analogies between the healthcare sector and investing in the healthcare sector and investing in Logtech. And I feel like isn't there are some kind of high profile investors, profile founders in the health tech space, but no one necessarily of that stature that you're talking about. Or if they are there, they're insiders. So I don't even know. So there's a CEO named Judy Faulkner, she's the CEO of Epic, which is one of the largest health tech electronic medical records, and it's just a massive, massive company, dominate the industry. She's super quiet. The company's been private the entire time. And it's just, I think there are a lot of similarities in terms of profile of founders in the supply chain and logistics space. So maybe they're of stature, but they're sort of within the ecosystem, right? It's a fairly insular ecosystem. So maybe that person's already there.
That that's
Yeah.
a great point. I don't know who Judy Faulkner is. I don't know her. So that's a great point. You can be massive within a very large community that is not really exposed to any other even enterprise software communities. So,
exactly. Yeah.
fair point.
Yeah. But so I again really appreciate you bringing me onto the show. Excited to be here. For those who don't know me or Newark Venture Partners, as Eric mentioned, I'm a principal of the fund. Our fund is really started in 2016. I joined the fund in 2017. So, just after our founding managing partners did the final close on the first fund. So it's really exciting to be sort of this part of this emerging manager story. But we're focused on early stage, and we could talk about what that means nowadays, but early stage B2B software investing. And we're fairly industry agnostic, but we draw a lot of our inspiration for investment theses from our namesake, which is Newark, New Jersey. And our first fund had a lot of strategic corporate LP investors that were also in the Newark, New Jersey ecosystem. So you can think about, Prudential and doing fintech, or Horizon Blue Cross Blue Shield and doing health tech, Audible and doing new media and audio. And, when we were thinking about our competitive advantage of being a fund and what we had in our ecosystem, Newark being the largest logistics hub of the Northeast, was just glaring, right? So we're about 2 years ago, really started investing or really understanding, just dipping our toe in the water to understand what's going on in the logistics and the supply chain space. We knew we had Newark Airport in our backyard, which is one of the busiest airports on the East Coast, the Port of New York and New Jersey, which is the busiest on the East Coast. We're at the intersection of every highway and rail line that you can think of running up and down this region. So we knew that we were sitting literally on top of a gold mine and understanding what runs and what opportunities there are in the supply chain and logistics space. So that's when we started investing here and there, and now we've made over about half a dozen investments in the space, and we continue to be really excited about it. So that's a little bit about the fund. Myself, I've been in finance for about 15 years. About half of that has been on the private investing side. Mm-hmm. I've followed companies from, I've actually gone backwards in my journey in finance, where I started on Wall Street covering blue chip companies, consumer healthcare, retail, moved into the private sector, joined a growth capital PE fund doing kind of smaller roll up or majority investments, and then moved to early stage. And this is, I think, just the most exciting place you could be right now in terms of being a private investor. So it's been great. And then sprinkled in with my history there is a variety of experiences, including teaching fifth grade or starting my own social impact venture focused on advanced manufacturing, actually. So bringing more access to advanced manufacturing to secondary cities like Newark.
Cool. Well, teaching fifth grade is probably the most challenging thing you've done, I would imagine, right? Out of all of them.
Honestly, it was really up there. So
Yeah, being behind the scenes on my son's second grade class all of last year, I always respected teachers, but I have a absolutely it probably 10x'd over 2019. So, um, well, let's dig into the market right now, because I can only, from the outside reporting on it, I can only describe it as absolutely bonkers right now. Um, what Let's maybe start with what areas in our space particularly sort of fascinate you, and then I have a whole bunch of other questions to ask. So
yeah. No, yeah. So yeah, I mentioned we've made a number of investments in this space, kind of ranging from understanding fleet dynamics with private fleets, or data transfer and visibility within the freight trucking space, or maritime. So we've made a number of really diverse investments, I would say, within Logtech, and we're actually right now in the process of refreshing our investment themes and questioning kind of where else do we think there are great opportunities. One, I'd say two areas that I think have come up as being particularly interesting is to think about the industrial robotics adoption. And a lot of this is driven by, e-commerce and 3PLs having to deploy all of this capital to run their distribution facilities and warehousing facilities in more economical ways. There's this influx of robotics technology. But I'm particularly interested in understanding, what's the software infrastructure around maintaining that, and optimizing those, robotics, enterprise robotics infrastructures. So I think that's really interesting. Don't really see that slowing down. And then also, I think we've talked about this before, as a little bit in the supply chain finance space, right? Because I think there's a natural progression, I think, in any industry where there's initial adoption of your key players of just technology. Maybe it's record keeping technology. You mentioned Salesforce, right? But then once you get to a point where there's enough underlying data plumbing, that data becomes really interesting for these like ancillary services and improvements in that. And I think particularly in supply chain, just because in certain roles, just the margins are so thin that if you can improve the financing component within supply chain, I think it becomes a game changer for how these companies operate, right? And freeing up capital, getting access to capital quickly, giving more visibility, and when the capital is coming in, it's just it's going to be a huge opportunity. So we're really excited about that as well.
I don't disagree. I really am keeping my ear to the ground on where the number of those types of platforms or solutions that are coming up, and when they actually start to get real traction. I think my sense is a lot of traction is going to happen when it's less of a logistics person's decision and more of a financial person's decision. That's because when I talk to shippers about, hey, are you dabbling in any sort of trade finance, supply chain finance tools that are adjacent to things that are out there already? A lot of it sounds interesting, haven't really played around with it much yet. Because I mean, this year especially, it's like, do I really have the time to think strategically about what my working capital looks like when I'm literally paying 10 times what I normally do for freight costs? And so right. It's understandable, but I agree. I think it's a massive opportunity.
Yeah. And that buyer that you're talking about in the finance role is usually kind of only there at a larger player within the ecosystem, right? So, and particularly because when you're talking about 3PLs or brokers or whoever, it's such a fragmented industry. So there are not that many massive players that maybe have the ability to have a finance department to figure that out. But again, that the data is the key player there. So if you can make that more accessible and then bring in maybe traditional finance partners that are interested in breaking into supply chain ecosystem. I think those are the components that make for a really interesting investment opportunity.
Yeah, well put. One question that I wanted, or one sort of issue that I wanted to discuss with you is that I see kind of thrown around a lot in our industry, especially where a lot of times there's not a winner takes all kind of market or mentality because the industry is so fragmented, especially when you look at global logistics. How do you sort of guide companies, or how would you counsel companies in terms of is venture the right fit for them? And secondly, are there companies that are not thinking about venture because they think it's one thing, but it actually is a great fit for them? So that's sort of, are there companies that think venture is good and it's not, and vice versa?
Yeah, no, definitely. I guess I would also maybe tweak the question a little bit, because I don't necessarily think that there are companies that aren't the right fit for venture. It's like a founder mindset that maybe they're not ready for venture dollars, right? I think the company itself is always going to be fluid, right? That they can change their market or product or features or whatever. The founder who's running the company really has to have the mindset, if they're going out to get venture dollars, to understand the dynamics of what drives a venture backed company, right, to success. So I've seen even in the supply chain space, two founders with different perspectives on how to approach a really similar problem, and one get funding and one not. Maybe partially of reasoning behind that is just like how they're pitching their vision of how this becomes a $100 million revenue company. And again, within the logistics space, right? Because I think it's just on the cusp of being one of these breakout industries, and with venture dollars pouring into it, it's a little novel, right? So a lot of founders don't necessarily have a roadmap to say, oh, well, we're going to take this idea, this one problem in supply chain and logistics industry, and then turn it into a unicorn. So yeah, it's nuanced there.
Well, it's very nuanced. You're right. I think one of the things I try to do, and I don't know how successful I am at it, to make it all about me, is I try to help the VC industry understand how nuanced logistics is, and vice versa, right? Because and the understanding of that is so much better now than it was when I started writing. And I have a little small piece of that. It's mostly just you need reps. Both sides need reps in understanding how the other side works. And so let's pan out and see what's going on in VC right now, because the categories of different rounds, you mentioned early stage, and whatever that means, has changed a lot. Like what is going on right now in VC? Why are we seeing, round sizes and valuations go up so rapidly?
I think a lot of it is driven by an abundance of capital. Just you see how quickly funds are raising capital, and how easily funds are raising capital to deploy. And so that means that when there's abundance of capital, the competitive dynamics change, right? And so it becomes more founder friendly, in that capital's cheap. If you're a founder, you kind of tell the right story, you're operating in the right space. It's much easier today to raise, it's crazy, but like a $7 million seed round than it
Or more.
was even 3 years ago. Yeah.
I just heard the other day.
Yeah.
Not in our space, to be clear, but
yes. And it's challenging, I think, from founder perspective too, right? Because there are definitely founders out there that are struggling to find capital, and they're like, well, everyone keeps talking about how the market is flooded with dollars, but I can't even raise $1 million pre-seed round. So there's a really good article. I don't know if you saw it. Sam Lessin. It was a opinion article by Sam Lessin in The Information.
I did read that.
called the End of Venture Capital as We Know It.
Yes,
It's
I
really
saw that.
great for those of you who are interested in just kind of trying to understand what might be happening in the industry. Go read Sam's article. Essentially, he's saying kind of the what we know as traditional VC, which is strategic, high risk, high reward dollars, going into these early stage companies has sort of been commoditized, right? There's the playbooks have been made. And so the mystique of venture capital has sort of been demystified. And then that means a lot of traditional finance players are moving upstream because like, oh, slower risk, that means we can play in it too. And so, you've got hedge funds, family offices also playing in the private investing space where they haven't been doing that before. But I think the good thing is he also mentions that there's still room for VC, traditional VC as we know it, in what he calls frontier spaces. But I actually think Logtech fits in with that, and that where there hasn't been an influx of private investing dollars or venture dollars into this space, into investing in technology in this space. And so it sort of becomes a new frontier. So we're constantly, again, looking for all of these not new industries or legacy industries that just haven't been touched or disrupted with technology as some others out there, right? And so I think that's definitely a space where I'm seeing more venture funds starting up. There may be specialty funds or larger funds breaking out and creating new supply chain investment themes. And particularly in the seed space, there's always going to be the need for dollars because there's just so much more that's unknown there.
Yeah. Thanks, Brian, by the way, at Chain.io for putting up the link to the story that Joanne referenced. I think I had it in one of my blogs a while back. So it was a very interesting point. And I remember a few years ago, back when I didn't know anything at all about venture, so I had no way to contextualize this comment, but it still rings true to me especially after what you described, is someone said, are they going to make a bot that essentially makes venture decisions, right? Like, will there be a venture firm that backs a bot-based venture firm, right? And because at some point the decision-making criteria could be automated, right? And I thought, well, obviously that could happen because anything can happen, but you're sort of describing like a path toward that, that we've moved down that. So super interesting. Let me shift gears a little bit and sort of get into this sort of cottage industry I see, especially. I'm super active on Twitter, too active on Twitter, probably for my own good. And one of the, corners of Twitter that I've been pushed into by the algorithm is venture Twitter, right? Whether it's VCs, whether it's founders, this is like the quintessential Twitter famous and not real world famous, gallery.
You've got sucked into the VC Twitter sphere
long ago. I
feel for you.
I'm in it. So my question is it useful? In any way, right?
I mean, admittedly, and if you can find my Twitter, I'm not a super active user on Twitter. And depending on who you ask, that's like blasphemy in VC. Some venture investors literally live on Twitter, source on Twitter, put up polls to due diligence on Twitter. So you can guess my stance on whether or not it's actually useful. I mean, if you're going to say is any of it useful, I'm sure there are great gems out there, but I think there's also a lot of noise. So if you're either a founder or like an investor trying to understand what's going on in the VC ecosystem by looking at Twitter, I think you'll probably get a pretty skewed view. Mm-hmm. I prefer like following Substacks or signing up for newsletters of like funds or investors that I think are doing a great job. Yeah. So that's my 2 cents again from someone that is not a very active Twitter.
As someone who consumes it, and now I feel like I have a good handle on what is actually useful or meaningful and what is not. It takes a lot of work. And you have to be,
Yeah.
just like with anything else, any other sort of like content source you consume, you have to be a really good editor for yourself around
Yeah.
what is valuable over time. Because someone may have a great thing to say on Twitter one day, and then you realize, you follow them and you realize the next 100 things they say are either all inaccurate or totally self-serving, and then you have to put that
Right.
first comment into context, right? Vice versa, you may hate something that someone says, and you may disagree with everything they say, but it actually ends up being really useful to understand their point of view on things.
Yeah.
So
Yeah, you can definitely just go down a rabbit hole, just have blinders on who you're following, and following who they're following and retweeting other people. And so I think definitely it can be a slippery slope, but I do think there is a lot of good stuff on Twitter. I will admit.
it's been great for me in terms of I've actually met like more people than I can actually count that have fundamentally changed my professional life. So it's been great, but it takes a lot of work to edit it to that point where it's useful. So what I want to sort of get into your personal experience. So can you kind of maybe give, without giving away your secret sauce, your own personal secret sauce, what's sort of a metric that you sort of use internally to decide whether, make a determination about your investment? Like what's sort of your, oh, that's when I know that's an investment for me or it's not an investment for me?
Yeah. Um, so again, I guess this is a good opportunity for me to define when I say we're early stage investors, what that means for us, right? So we're writing up to $2 million, up to $2 million initial check into companies that are raising their seed, which might be like maybe a $4 to $6 million round. So if we can put 2 out of 4 or 2 out of 6, we can lead, we can participate. So if they're labeling that a pre-seed round or a seed extension or a seed, that's just the kind of sweet spot in terms of the round dynamics that we would play in. So I think at that stage, and these are typically companies that have a product in market, have some early traction to point to. It might be really, really early, but there's just there aren't that many metrics to even go off of, right? So I do really rely on trying to be a good judge of whether or not these founders, again, as I mentioned before, like have the right mindset going into building a big venture-backed company. So that founding team is so core, because the company itself is going to be fluid, and it has to be fluid as it's going from seed to A to B to C when it comes to product or customer profile or market problem. But I guess what has to exist for that successful CEO founding team is that they can like really articulate their confidence in being able to build a big business or $100 million revenue business. You know, can articulate that roadmap really well. And I think sometimes VC as an industry gets a lot of slack because they're like, oh, we're pattern matching. We're looking for repeat founders because they know how to build a big business. And that's not necessarily true. Like we've invested in a lot of first-time founders. It's hard to try to formulate what exactly that it factor is when you're talking to a founding team. And a lot of it also is just like market timing as well, right? It could be a great team building and trying to solve a really unique problem, but we just don't think the market is there to adopt it fast enough to grow within the 5 to 7 year time frame that we need them to grow at. So it's really hard to say that, oh, we're judging founders. It's the culmination of a lot of things. So I think I'm going to take my chance to say this like really overused phrase in venture, but it sort of depends, right? There's a lot of different factors that happen, but I think that's one of the most important things when we're talking about a founding team and understanding where they're coming from is like, do they have the vision and ability to build that $100 million revenue business in this space at this point in time in this industry in the next 5 to 7 years?
Yep, that's super helpful, and I think a good encapsulation of kind of the challenge at early stage, right? So
Yeah.
I do want to emphasize for people who don't understand the space how important it is at the like what role early stage uh, VC firms play in the bigger ecosystem. This isn't necessarily anything you need to respond to, Joanne, but like determinations about company paths are really made very, can be made or broken with these early stage investments. So you and your cohorts play a really fundamental role in kind of like what actually ends up happening in our industry. So
Yeah. And I guess one other thing
go ahead.
I want to add to that, right? So I think there's always two sides of the spectrum. There are founders that are solely obsessed with building a big business, that a lot of the fundamental structures of building a sustainable business kind of go out the window, just because they want to grow revenue or top line, right? So, and I think we've seen a lot of really high profile unicorn companies come to their knees because maybe they weren't focused on building culture, or they were too obsessed with almost taking advantage of the customer, and not really generating true value, right? So there are two extremes. I'm not saying that as long as the founder can build $100 million revenue business, we don't care what they do. We want to know that they're building a product for a specific industry problem that we validated and is a big enough market opportunity. But yeah, there's two extremes to it.
Sure. Yeah. No. Good. Very good point. Can I put you on the spot a little bit and ask? And you don't necessarily need to name companies. I'm just curious. Like, is there one investment, especially in our space, that you sort of kicked yourself that you didn't make, that you were sort of on the fence on, and vice versa, one that maybe you made that if you could have gone back, you said, no, it probably wasn't a good decision to invest in them.
Yeah.
Not to suggest you don't hit 100% of your investment. But
I hate interview questions to start, not to put you on the spot. No. I actually, in the venture industry, if you don't have those companies that you feel like you missed on, you're probably not doing a good enough job or not seeing enough opportunities, right? And that's something that my partners say all the time, right? If we don't kick ourselves, and I think there's another fund that releases their kind of non-portfolio, and they highlight all the opportunities that they essentially missed and talk about why. So yeah, I think it's Bessemer. And yeah, so there are definitely ones that we've missed out on as a fund. I've missed out on particularly. There's actually, we often just shoot an email out to our investment team. We're a small team. We've got 3 managing partners and 2 principals and an analyst. So, we're always just constantly shooting emails back and forth and saying, oh, did you see this company raise? We saw them in 2016, or, oh, this company just raised a Series C. So not too long ago, we were sharing that there was a seed stage opportunity in 2016. I think that it was maybe a convertible note round. It was a $9.5 million cap. They even had some traction, which was like, oh, great. At the time, I guess it was 2016, so it's a slightly different market. And they were software enabling sort of an SMB industry, highly fragmented. And so we ended up passing, but I think they just recently announced a Series C raise at like a $750 million valuation. And they raised their seed round in 2016, and we're like, oh, well, just missed that one, And it's really interesting to go back and talk as a team about, what we liked, what we didn't like, what we didn't see that, we were maybe blinded by. So
yeah,
it's fascinating.
As I was thinking about asking you this question, I thought my son takes tennis lessons, and his coach just recently told him, do you know, even the best players in the world, Novak Djokovic, Roger Federer, they lose about almost half the points they play, right? So
Yeah.
I thought about that in terms of VC. Like if you take big swings, you're gonna miss, right? Every once in a while, right? And vice versa.
Yeah.
So one really quick last question. We have about a minute left. I asked this question on a panel at our TPM conference earlier this year to a couple other VCs, and I'm curious for your take because things have changed a lot in the last 6 months. How many billion-dollar companies in Logtech? And I know that's a little more of a smaller category than supply chain tech, but in Logtech, how many billion-dollar companies will there be in the next decade, do you think? I'm going to hold you to 2030, by the way, Joanne.
I'm gonna in Logtech specifically. I'm gonna say, I want to say like 150, which I think
Okay.
is a lot, right?
I think that's a lot.
How many? Well, how many are there now, right? So,
Not very many.
I know about the unicorn ecosystem. I think there are about like, I don't know, close to 1,000 unicorns globally now.
Yep.
But what was really interesting, CB Insights has this tracker on it, and one of their recent like refreshes, they were saying more than half of those companies have made the list in the last 2 years. So just again, I think it's a testament to how much private investing is going into these companies, maybe spinning up the valuations a little higher than they are necessarily should be. But if the question is how many unicorns based on valuation will exist 10 years from now, I mean, I think it's growing incredibly fast. The supply chain and logistics industry in particular, there's a lot of dollars, it's attracting a ton of dollars at the early stage that I see. So I'm being really aggressive. I'm going to say like 150. It's crazy.
Cool. Well, Joanne, thank you so much. It's been fascinating. I love chatting with you, and I'm glad we got to take our chat in front of an audience here and look forward to talking to you more. So thank you so much for joining us today.
Great. Thanks, Eric.
All right. So we have about 3 minutes left. I'm going to roll through dad jokes of the month really quickly, and then we'll get into buzzwords explained. So I have two this month, one for myself and one from my son. I'll start off with mine and encourage you all, as usual, to throw your favorite dad jokes and mom bombs into the chat. So here goes. My first one. What do you call someone who doesn't care about farmers? Agnostic. What do you think about that one? Is that decent? I came up with that myself. I didn't even read that anymore. So, and it actually works because Joanne mentioned agnostic, I think, earlier in the episode. So, so now you get my son's joke. What do you call it when two dinosaurs crash into each other? You all, parents probably have already read this in one of those joke books. T-Rex. Or Tyrannosaurus Rex, right? So there you go. Those are your two dad jokes for the month. Please put your thinking caps on and think of some good ones for next week or next month, I should say. You have 30 days. Come on, I want to see us up the ante on this. So before we sign off, every month I'm going to take one buzzword that we hear in logistics technology and see if it sort of passes the smell test. Again, this is just my totally uneducated thought process on this, but today we're going to talk about no code, low code. I actually think this is quite an interesting concept, and I think we're going to see more of this as sort of software proliferates in the industry. Almost every company I talk to now talks about the impact of empowering users in a way that they hadn't before. This goes way beyond user interface. No code and low code is essentially allows a person without any sort of technical background to configure or create an environment using a piece of software that traditionally a programmer or an engineer or some IT technician would need to do for them on the back end. So it's sort of taking a lead role in configuring how your user experiences through through the interface, basically. So it's, if you think about it, the best analogy I could think of is when you open your iPhone, you can move around all the apps on your phone through a pretty simple process, right? When they shake. That's a very simple version of, in my view, of no code, low code. You're able to configure your view based on the ability to move things around in your own environment. So, widen that out to a very sophisticated logistic piece of software that's coordinating all sorts of things in logistics, and there you go. So thumbs up on low code and no code. I think it's going to be super impactful in the years ahead. Thank you everyone who tuned in. Thank you again to Chain.io for sponsoring today. Check out my Twitter feed, Logtech Eric. Check out my Substack, eric.johnson.substack.com. Obviously check me out on joc.com. Thank you all again, and we'll see you next month. Bye everyone.